My name is Darren. Our team seeks to demystify the sometimes confusing world of international tax. Which Asian jurisdictions have territorial tax? And for those who are unfamiliar, territorial tax being that tax is only levied against income that arises from within their borders. They don't tax worldwide income like Portugal or Spain does, where once you're tax resident in Portugal, you're going to be taxing your worldwide income, regardless of where it sits, regardless of which account it's in. It's subject to taxes in Portugal. In Asia, you do have the option of territorial tax, but I want to put like a health warning. It's not pure territorial, textbook territorial tax. There are circumstances where even though the income arises from outside of the jurisdiction, it will still be subject to taxes within the jurisdiction in question. So it's not pure territorial, but it's close enough. So the two most popular, of course, would be Singapore and Hong Kong. Hong Kong being particularly attractive to those who do business in China, or increasingly, just being honest, as a hedge to certain geopolitical trends. So, for example, when certain countries in Northern Europe went to war, just by virtue of being a national of one of those countries, you may have had difficulty banking, you may have had bank accounts frozen and stuff like that. There's a feeling that maybe I want to hedge my position, and maybe Hong Kong would be a jurisdiction to do that. So I'm just kind of throwing that out there. But generally speaking, Hong Kong is your gateway to China. Singapore, your gateway to Asia in general, and some people see it as just your gateway to the world in general. Three other jurisdictions to consider will be, well, next door to Singapore is Malaysia. Malaysia's tax system is quite similar to Singapore. The effective tax rate is probably going to be higher, but it is an interesting jurisdiction depending on what you're trying to do. And then you have Thailand and the Philippines. In Thailand, you have like a remittance-based taxation system that says more or less, if you remit the funds that you earn into the country and you're a tax resident there, but you don't remit it in the year in which it is earned, you're not going to tax it. So if you earn money in 2024, don't bring it into Thailand in 2024, do it in 2025. And the Philippines, that's probably like a jurisdiction for the more budget conscious individual, in that it is the cost of living is perhaps arguably the cheapest in the jurisdictions that we're discussing. English is spoken from an Iberian perspective. It's a former Spanish colony, so the local language has a high percentage of familiar words. So that could also be interesting. And their legal system derives from Spanish law. So it's a weird combination of civil and common law. So it's not unfamiliar to those from Iberia. If it is that you're not a Filipino citizen but you are a resident, you only tax on income that arises from within the Philippines. So no foreign income. Having said that, all of those jurisdictions have the principle of what we call an international tax permanent establishment. So if you're still in the stage of your financial journey where you're running a company or you're still operating a company and you move to one of these jurisdictions, even though it may be territorial, if it is that your company is incorporated in wherever else in the world it may be, but the place of effective management or the seat of management, otherwise known as mind and management, management and control, whatever the terminology would be in the relevant legislation, if it is that you're running the company from within their borders, even though the money is being collected in a bank account outside and the clients are outside, but you're running it from within their borders, they may have the right to tax it at the corporate level. So that's something to bear in mind.